This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's mineralware.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to cover the latest mineral rights and oil and gas news for August 2026. And Justin, it has been an up and down year as far as oil prices, which we'll talk about here at the end. But before we get to that, there was an interesting development in Erie, Colorado. We reported a couple of months ago about the city council agreeing to some swap of minerals, selling minerals, swap of land with SM Energy. Do you want to talk about this first story?
Let's do it. Yeah, there's a lot going on. There's a lot of pieces and parts to this. The article says here battle raging over a proposed 26-well fracking project just outside Erie, Colorado is unlike other Colorado oil and gas disputes that have come before. It was complex and multi-layered. A 48-page mineral access agreement at its heart has stirred questions and suspicion among residents of fast-growing Erie, which straddles Boulder and Weld County. So, Matt, opposition here, I don't think is a terribly surprising thing. We both kind of live close to this area, and so this could be somewhat expected. But also the article goes into that there's some questions about what exactly is owned. There's some unclear title. That may not be a terribly large surprise either, Matt, but things to work through. On one hand, the community is, trying to give some opposition to this. And on the other hand, they're really working through the fine points of doing the research, retaining the organizations they need to get this done, so on and so forth.
Yeah, and it's sort of it's kind of really an ironic development. And I'll tell you exactly why I say that. What's happened here is that local residents have filed a petition to put this on the ballot. So again, for those of you that may remember when we covered this story a couple of months ago, the city council approved a deal with SM Energy to sell Erie-owned underground minerals, and they were going to get $35 million, and the company was going to give them 160 acres of surface land as well, so they could build open space. It would be a new park, all this green space, all these things. And then in exchange for that, SM would also plug and abandon, I want to say it was 30 plus old wells. And so these were orphan wells or abandoned wells that had not been plugged appropriately. And so again, they were going to do all this, which would benefit the residents of Erie, both financially to the city, and then also with that additional green space and then plugging and abandoning those wells. And so if this gets overturned, which is what this ballot initiative is seeking to do, then all of that would go away. The minerals would still get developed because the surface location is located east of the Erie town line in unincorporated Weld County. And so Erie has no jurisdiction. They can't prevent this development from occurring, which is the development's already been approved by the Colorado Energy and Carbon Management Commission is what it's called now. And, the wells are going to be 7,000 feet deep under the town. And so, no effect to the residents really, living in Erie proper, because it is outside of Erie. But the interesting thing is that I think there would be still a benefit to Erie, whether or not this thing gets overturned, the agreement gets overturned, Erie still would get money from that. And presumably if the agreement to sell the minerals to SM Energy got overturned, they would just get the royalties from these wells based on the town-owned minerals. But, it's really kind of ironic. And in fact, I saw a editorial by somebody that was actually pretty anti-oil and gas and pro, progressive, I'll call it. And they said, actually, I think this is a good deal for us. We should allow it to occur because this development is going to occur whether we want it to or not. But by allowing this agreement that the city council put in place, is going to be a net benefit to the Erie residents and actually reduce pollution and do all these things by providing additional green space and all these things like that. So really kind of ironic in that from that standpoint that they're opposing this. That would be a net benefit in my mind, from the things that the SM had agreed to do, because it's not going to stop development. It's just really blocking the agreement that the town council agreed to. So yeah, it's, I guess, not a huge surprise. You have this not in my backyard contingent, and, largely because it is so close to Boulder, I'm sure there's a large amount of people that are, working closely within that whole community as far as, opposing oil and gas development, but it's got to come from somewhere. And this is they're doing a lot to clean up, again, orphan wells, and to do this in an environmentally conscious manner, because frankly, Colorado has some of the most strict oil and gas regulations and, limiting emissions and limiting impact to communities. So if it doesn't get done here, it's going to get done somewhere else, and arguably with lower environmental protections. So I
think you summarized it well, Matt. And that it's interesting to see how this will play out. And again, they're fighting because of the agreement, but the agreement really isn't the overarching thing that'll win or lose the battle, whether there's going to be development. So I'm sure this will play out, and we'll see what happens. Matt, the next one here is a pretty interesting one that happened. So in Arkansas, the appeals court ruled in favor of landowners in a oil and gas royalty dispute. This was a class action lawsuit involving royalty payments under Arkansas oil and gas leases. And at the heart of it, Matt, it doesn't cover a whole lot. What was decided was pretty narrow. Basically, they were saying that there's an Arkansas statute that has been used, and the operators argue can override the clear lease language, and then that lets the operators deduct post-production cost. And that's the class action lawsuit ruled against that, saying that was not the case, though it doesn't really impact a standard for what happens when a lease is silent, or doesn't really define what royalty payments are, the amount of royalty payments, so on and so forth.
Yeah, this one was confusing to me, and so I had to do a little bit extra digging. And, from what I understand, the company that was being sued is called Flywheel, and they had started deducting post-production cost from royalty checks in 2019. And they were doing that by arguing that the state's net proceeds statute gave it the right to do that, even though the leases mentioned gross proceeds, which that infers no deductions are allowed. And so ultimately, this just affirmed that whatever is in your lease is the deciding, document. It's takes precedent over statute. When you're looking at contract law, it's the lease that will prevail, and the operator can't use maybe a competing statute as a backdoor to take deductions that the lease doesn't authorize. And so that's ultimately what this means. And so if you have a lease that mentions gross proceeds, in other words, no deductions, then this is favorable to you and would prevent an operator from being able to deduct that based on the statute that is the net proceeds statute. If you don't have, mention of gross proceeds, if your lease is silent on post-production deductions, then you probably doesn't have an impact on you. And, the operator may be able to obviously consult with the Arkansas oil and gas law if you're concerned about post-production deductions on your royalties. But, just an interesting, decision here. And, this is part of, I would say, oil and gas, particular royalty law that is hotly contested. It's always the fine line that operators are trying to work to deduct as much as they can legally. And then on the other side of that, royalty owners trying to make sure that, nothing is deducted if we had a say. And so there's that balancing act, but based on the legislation and the case law, And in this case, it was, I think, benefiting royalty owners to a certain extent, particularly if you had certain lease language. But yeah, an interesting ruling here on the appeals court.
This is an area where case law can really change all the time, and things can happen. They can become the norm. And then there's new case law that sets a precedence or even calls into question and requires it to go forward. And, Texas, I think, is infamous for having these cases all the time on different aspects, whether it's lithium or whether it's just how to interpret an ambiguous lease.
Yeah, that's a great point. I know you pulled a couple of stories before we hit record. We were talking about one related to overriding royalty interest washouts, and then another one related to double fractions and, fixed versus floating royalties, which seems to be a never-ending battle in Texas and is very confusing. But, that whole non-participating royalty interest language and how it can really go one way or the other depending on the language in the conveyance. And so those are some that I think we'll probably have to have an oil and gas attorney on to talk about those and the implications for Texas royalty owners. Certainly there's been, to your point, a lot of case law that's been decided in the last year or so in Texas. But, I'm sure as everybody's listening to this, they're curious as to what's going to happen next with oil prices. I know I am. You want to talk about this next story?
Sure. So highlights here, the oil prices fell to a 3-week low on Tuesday, as Senator U.S. officials raised hopes of a deal with Iran to reopen the key Strait of Hormuz. And Matt, the article goes on to say, on Tuesday, which would have been August 4th, it was the lowest level since July 13th. It dropped 5% to 76 a barrel. And so, Matt, this has kind of been the game here where it goes up and down based on what we believe to be happening in negotiations with Iran, though, the true story is never really available to us.
Yeah, it's not until, I guess, it's in ink and it's been decided and we're, out of that part of the country with our military forces. And so that probably is going to take a while, despite whatever the news says from one day to the next. And oil markets are so on edge, and I would say that they're so tight right now in terms of supply. Any incremental supply can have a big impact on price because we're sort of in a situation where demand exceeds supply because of the Strait of Hormuz being closed for the past several months. And, then we saw that with oil going up to $100 a barrel when hostilities resumed a few weeks ago between the U.S. and Iran. And then, when a deal was on the table again, then of course it dropped back down to about $76 a barrel. So I think from a mineral owner perspective and royalty owner perspective, the takeaway is, take each of these moves with a grain of salt. Ultimately, you got to think long term about what's the average price of oil and average price of gas going to be over the life of my assets. And, over the long term, I do think we're looking at, certainly the next several years, probably $60 to $70 a barrel is probably where we'll end up, or even potentially lower, because there's a lot of downward pressure from the economy, and things going on there, that once the supply and demand sort of settle out after, at this point, it's probably going to be next year or some point, then I think the market fundamentals will drive prices again instead of the geopolitical stuff going on. Of course, I say that, and who knows, the next thing's going to pop up next year and that we don't know about today, and that could change everything. But I guess, and I had a conversation with a client recently. They were looking to sell and wanted to get very aggressive on price because that was right after the prices spiked back up to $100. But I had to remind them that, if somebody's going to invest and buy their interest, they can't bet on $100 oil. They're looking at it long term, and they're probably banking on, $50 to $70 oil. And so that's what their price is going to be based on. So, take advantage of it while you can, while these prices are high, cash those royalty checks and enjoy that a little bit of a bump. I know that it's always nice to have that. But on the other hand, I know I've been filling up my car and when prices spiked up again, price of gas here in Colorado is back up above $4.30 a gallon for regular gasoline. So, it's kind of in my mind, negating all that additional royalty income that I'm getting, because my expenses are higher because fuel prices are higher and stuff like that. So it's kind of a give and take, I guess, from that standpoint.
Yeah. And I think, from a long-term standpoint, it can really hurt the stability as companies look at budgets as well. If we don't know what's going to go on, neither do the companies that need to appropriate money and figure out what's going to happen. So most companies will choose to play it safe and certainly not grow, which could have a much larger impact on our royalties.
Yeah, that's a great point. And speaking of that, let's talk about the rig count.
So there's not a whole lot of change week to week, Matt. So we're up one total, but I thought where these were was interesting. So we gained one in Louisiana. There was one in Texas and then one in West Virginia. So interesting to see West Virginia growing. I know the East chapter of the National Association of Royalty Owners has definitely been busy and trying to help serve West Virginia because there is growth and a lot going on there for leasing up acreage. So Matt, overall, not a lot, but before we hit record, you were talking about that you looked at last month's and, overall, though we're looking at it week to week, there's a growth here.
Yeah, when we reported this last month, we had 551 land rigs. Now we're at 572. So we're up about 4%, just under 4% month to month. So, the higher prices are starting to trickle down into slightly increased drilling activity. But when you look at it, compared to where prices were at the beginning of the year, certainly prices are up significantly, more close to like 50%. And despite that, we're not seeing 50% additional drilling activity. We're seeing 3 or 4%. So I think that speaks to your point, Justin, that companies are being cautious. And, from what I've seen, certainly the public companies are reinvesting in dividends to shareholders and then stock buybacks, which are maybe a little bit more safe from the market standpoint. They're liking to see that more than increased drilling and risk, debt and other things like that could go along with that. And so that said, though, there's, we're starting to see, again, this whole concept of record profits, right? That's getting reported by the major oil and gas companies. I just saw a few headlines about companies like BP and Exxon and Chevron and stuff that are reporting increased profits, obviously because oil prices are higher. But, the bigger story, I think, is that they're not going gangbusters on drilling new wells, that it's really being cautious optimism, I think, is the mindset. And, we're starting to see it trickle up. But I wouldn't expect to see a big step change. We'll see a few rigs getting added here to here, every week. And then, eventually it'll add up to being, higher than we were a month ago. But I don't see it being a rapid increase by any means.
And there's a lot of movement around to different areas we've noticed as well, Mount, throughout this year. And so though there may be movement, they may be moving from one area to another and moving capital around. Again, that was already decided. We talk a lot about how these companies typically work on a fiscal budget. So they make plans for a year and try to execute, though they adjust some.
Yeah, that's a great point. And, I think between now and the end of the year, since we're getting into the third quarter at this point, that we'll start to see, if they have excess cash, then perhaps they're going to look to spend it this year. So there might be some slight adjustments to budgets, and you just monitor your operator. If you have a publicly traded operator, go to their website, look at the investor presentation, see what they're saying, and that'll give you some insight into the timing of when, if they have wells that are permitted or if they are active in your area. Then you can sort of read between the tea leaves to see, are they going to be doing a lot more drilling, or is it sort of the same pace? And you can use that to judge how that might impact you. But it's always interesting to follow it along. And, again, it's sensational headlines or just because that's what sells and it gets clicks and stuff like that. And so, the fact that we're hearing rumblings of windfall profits tax again is not a surprise. It's very short-sighted, but it's, again, what politicians do, is to get headlines to say, hey, we're doing something about those high prices. We're going to bring prices down for you. And really that would do nothing but increase prices, because it would make it, so that companies are doing less drilling, which is going to decrease supply, which would be silly. So, just take all those headlines with a grain of salt. Don't get too worked up about it. It's just there to show that they're doing something, but ultimately nothing's going to come of it, I don't think. So,
like we say, time will tell, and there will be no lack of it moving up and down as things change.
That is absolutely correct. Well, and that wraps up this month's news episode. If you have an article you'd like us to cover, you can send it to feedback@mineralrightspodcast.com. And as always, we'll link to the articles discussed in this episode in the show notes, which can be found at mineralrightspodcast.com. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.